Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at advanced micro devices.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, it really helps us out.
Okay, let's unpack this. Because we are looking at a really wild situation here. Over the last 90 days, the top executives at Advanced Micro Devices have sold $55.4 million of their own stock.
Right, which usually sets off alarm bells for any investor.
Exactly. But then, simultaneously, you have the smartest, most well-funded hyperscalers on Earth committing literally billions of dollars in infrastructure just to buy their chips.
It's a massive contradiction.
It really is. So today, we're figuring out who is actually on the wrong side of this trade, because someone has to be right.
Well, to understand that disconnect, you really have to look at the structural transformation of their revenue. I mean, for fiscal year 2025, they reported a record data center revenue of $16.6 billion.
$16.6 billion. That is just staggering.
It is. That represents a 172% year-over-year growth. They basically took a multi-billion-dollar enterprise division and nearly tripled it in a single 12-month window.
Which is unheard of at that scale, but I feel like the market is still struggling to price them accurately because, the legacy perception of the brand hasn't entirely faded.
Oh, absolutely. I mean, for decades, their core identity was tied to consumer electronics, right? They provided the silicon for budget laptops and gaming consoles.
Right. It was a very cyclical, relatively low-margin business that was just heavily dependent on everyday retail consumer spending.
And that legacy model just operates on entirely different financial multiples than enterprise infrastructure. Selling a processor for a consumer laptop yields like a fraction of the margin compared to selling high-performance server architecture to a major cloud provider.
So that $16.6 billion figure, it basically confirms they aren't a consumer hardware vendor anymore.
No, not at all. They are a foundational pillar of high-performance data center computing now.
It's kind of like imagine a reliable, high-volume consumer car company quietly retooling their factory floors over a decade, right?
Okay, right.
And then suddenly, they emerge as the premier manufacturer of rocket engines for orbital logistics. You just cannot apply the valuation metrics of a sedan company to a business operating in the aerospace sector.
That's a great way to put it. The capital expenditure cycles of their clients have completely changed, which is why their dual-engine growth strategy is so vital right now.
Right, because they aren't just selling one piece of the puzzle.
Exactly. They are attacking the data center architecture from two distinct angles. You have the AI accelerators, which are the GPUs, and then you have the server CPUs. They are supplying the entire computational drivetrain.
And we really need to analyze the technology driving those enterprise sales, because honestly, the narrative around artificial intelligence over the last few years has been entirely monopolized by GPUs.
Yeah, Nvidia's dominance in raw parallel processing has been basically the sole focus of the market.
But now, suddenly, everyone is talking about CPUs again. The server CPU is becoming the focal point of the data center architecture. Why is a traditional CPU suddenly gating the performance of these massive billion-dollar AI clusters?
Well, what's fascinating here is that the mechanics at artificial intelligence are shifting rapidly. We're moving from training to inference.
Specifically, agentic inference, right?
Yes, exactly. In the initial phase of AI development, companies were just brute forcing massive data sets through language models to train them.
Which just requires pure, unadulterated parallel processing.
Right. And GPUs are uniquely designed to perform, millions of simple mathematical operations simultaneously. But once the model is trained, the workload completely changes.
Because an agentic AI is not just sitting there passively generating text in a chat window, it's operating autonomously.
Exactly. Think about it. If you ask an agentic AI to, say, organize a business trip, it has to break that down sequentially.
Right. It has to query an airline API, then scrape a hotel website, maybe authenticate a payment processor, and just run a whole series of logical, multi-step decisions.
And those sequential, logic-heavy tasks cannot be efficiently processed by a GPU. They require really complex traffic routing.
Which falls back on the CPU.
Yes. In the data center, the server CPU acts as the head node. It receives the prompt, breaks it down into individual tasks, routes the parallel math to the GPU, handles the API queries itself, and then stitches the final output all back together.
Oh, wow. So the CPU is doing a lot of the heavy lifting there.
In these modern agentic workflows, CPU-side processing actually accounts for 50 to 90% of the total latency.
50 to 90%, that's massive.
It is. If your central orchestrator is slow, your $50 million GPU cluster just sits idle waiting for instructions.
Which places advanced micro devices in a uniquely powerful position, right? I mean, in the fourth quarter of 2025, they captured a 41% value share and a 29% shipment share in the server CPU market.
They effectively control the highest value real estate in the data center. By owning the overarching EPYC processor, they have the perfect integration point to bundle their own accelerators.
And the current iteration of that accelerator is the MI450 GPU, right? Which introduces some pretty significant architectural advantages.
Definitely. It's fabricated on TSMC's advanced 2-nanometer node. And operating at 2 nanometers means packing transistors so densely that you are basically brushing up against the physical limits of silicon manufacturing.
It's mind-blowing. But the primary advantage of that density is thermal efficiency, isn't it?
Yeah, exactly. Power consumption and cooling are the absolute hard limits of modern data centers right now.
Because you can only pack so many compute units into a server rack before the ambient heat literally physically melts the hardware.
Right, or you just flat out exceed the local power grid's capacity.
Mm.
So the 2-nanometer architecture allows them to push higher compute performance within the exact same thermal envelope.
But compute speed alone is kind of irrelevant if the system suffers from memory bottlenecks, right?
Spot on. And that's where their Helios rack scale solution comes in. It utilizes 31 terabytes of HBM4 memory.
Which actually outpaces NVIDIA's competing NVL144 racks in terms of raw capacity, if I'm not mistaken.
It does. When you're dealing with trillion parameter language models, the data must remain in high bandwidth memory, situated physically close to the compute cores.
Because if the system has to go fetch data from slower external storage arrays, the latency just renders all that processing speed totally meaningless.
Exactly. So the hardware specifications are highly competitive.
But I have to push back here for a second, because pure hardware doesn't break a software monopoly. NVIDIA's CUDA software ecosystem has locked developers in for over a decade.
That's the big hurdle, yes.
So are hyperscalers like Meta and Microsoft actually adopting the MI450 because the open source software is finally viable? Or are they just diversifying out of desperation because they literally cannot secure enough allocation from NVIDIA? Are they just picking up the scraps?
It's a fair question, but framing this as just overflow demand really misreads the fundamental economics of cloud infrastructure. Being the definitive second source in a sector this critical is actually a massive, highly lucrative competitive moat.
Really? A moat?
Yes, hyperscalers operate at a scale where supply chain monopolies are existential threats. If Nvidia maintains a 95% market share, cloud providers lose all leverage on hardware pricing.
Oh, right. They lose the ability to demand custom silicon variations.
Exactly. And they are entirely exposed to a single point of failure in manufacturing. So they are heavily incentivized to actively fund and scale a second ecosystem just to maintain equilibrium in the market.
And Meta recently formalized this, right, with a multi-year partnership for up to 6 gigawatts of GPU deployment.
Yes, and we need to pause on that number. 6 gigawatts is an unfathomable amount of power.
I mean, we are talking about the energy equivalent required to sustain multiple metropolitan cities, dedicated purely to operating these server clusters.
A capital commitment of that magnitude requires deep architectural integration. You do not commit 6 gigawatts of infrastructure to a vendor unless you view them as a foundational partner.
That makes total sense. And the OpenAI partnership provides an even clearer view of this integration, I think. That deal involves warrants for up to 10% of Advanced Micro Devices stock.
Right. Structuring the partnership with equity warrants completely aligns their long-term incentives. OpenAI has a direct, vested financial interest in ensuring this hardware actually succeeds.
So they are financially motivated to optimize their proprietary models to run flawlessly on this new architecture.
Exactly. They're effectively doing the heavy lifting of breaking the CUDA software moat themselves.
Wow. And you combine that with Supermicro launching dedicated enterprise systems optimized exclusively for these EPYC processors, and you have a highly sticky hardware ecosystem.
Furthermore, the broader macroeconomic environment is providing some pretty significant tailwinds for these infrastructure buildouts right now. We are seeing a sustained period of sliding global energy costs.
Which is massive for hyperscalers running gigawatt-scale data centers. I mean, energy is their primary variable operating expense.
Right. When utility costs stabilize or drop, those companies free up massive amounts of operational capital.
Which is then immediately redeployed into hardware upgrades and custom silicon research.
Exactly. And we're also tracking the market optimism surrounding the ongoing U.S.-Iran negotiations.
And just to be clear, we are treating that purely neutrally, just looking at the economic impact. We aren't taking any political stance on the negotiations themselves.
Of course. But strictly from an economic perspective, easing geopolitical tensions in the Middle East reduces the risk premiums associated with global shipping routes.
Right, and raw material logistics. Predictability in the supply chain just lowers the cost of goods sold across the entire semiconductor sector.
Which allows manufacturers to forecast yields with much higher confidence.
Okay, so the structural pivot is complete, the hyperscalers are deploying the hardware, and the macro environment is favorable. But the valuation metrics paint a highly complex picture.
Very complex. The stock is currently trading around $245.
Right, and analysts at GS Securities have established a price target of $311, which implies roughly a 26% upside.
Yeah, and the company boasts a financial strength rating of 9 out of 10, plus a growth rating of 10 out of 10.
Which is great. They have the free cash flow to fund these complex 2-nanometer tapeouts without taking on distressed debt.
But the market is fully aware of those strengths, and they have priced the stock accordingly. I mean, the forward price-to-earnings ratio is currently sitting at 93.14.
That is steep. To contextualize that for you, Nvidia is trading at a PE of approximately 39.5. You are paying more than double the premium for every dollar of current earnings here.
And the PEG ratio, which measures the PE relative to the expected future growth rate of the earnings, exposes an even wider gap. Advanced Micro Devices is trading at a PEG ratio of roughly 0.8.
Which is exactly double Nvidia's 0.4 ratio. So a 93 PE multiple implies that the market has completely eliminated any margin for operational error.
Right. The share price assumes absolutely flawless execution across their entire product roadmap for the next 3 years.
If the transition to the 2-nanometer node results in, say, lower than expected yield rates, or if enterprise adoption lags by even a single quarter, that 93 multiple will contract severely.
The valuation requires perfection. Which brings us back to the insider selling data.
Yes, here's where it gets really interesting. Over the past 3 months, corporate officers and board members have sold $55.4 million worth of equity.
And over that same period, there has not been a single insider purchase on the open market.
Zero. Now, analysts often dismiss heavy insider selling as, routine wealth management or scheduled diversification for executives who are heavily compensated in equity.
Sure, that's a common defense.
But $55.4 million with zero corresponding buys. While the stock demands a 93 multiple, that is really difficult to ignore.
It is. Executives with direct visibility into the supply chain and manufacturing timelines are systematically reducing their exposure.
It creates a stark divergence in market sentiment. If you take a bearish stance, you view that 55 million as a leading indicator.
Right. The bears would say the insiders recognize that scaling 2-nanometer production from test chips to volume manufacturing is a brutal engineering challenge.
They understand the execution risks and are locking in gains before the broader market recognizes any potential timeline slippage.
But a bullish investor looks at the 172% data center growth and the meta infrastructure commitments and just concludes that the executives are simply taking profits after a historic multi-year run-up.
Regardless of the interpretation, though, a multiple this high, combined with significant insider exits, it definitely caps the short-term sentiment.
Absolutely. You cannot blindly buy in at these levels without a strict catalyst strategy.
So navigating this requires tracking specific operational milestones over the next 12 months. And the immediate stress test arrives on May 5th, 2026, with the Q1 earnings report.
Right. The consensus expectation is $1.27 in earnings per share, generated from $9.87 billion in total revenue.
But the top-line revenue beat will likely be secondary to the internal segment breakdowns, wouldn't you say?
Oh, for sure. The market will forensically examine the data center numbers. They must prove that the 172% growth velocity wasn't merely a temporary spike from initial hyperscaler deployment contract.
It has to be a sustainable run rate.
Exactly. And then as we move into the second half of 2026, the critical catalyst is the volume production phase of the MI450 GPU.
Because announcing a 2-nanometer chip is largely theoretical, right? Fabricating it at commercial scale without prohibitive defect rates is what actually dictates their gross margins.
Yes. The semiconductor industry is littered with companies that design brilliant architectures but fail to yield them profitably in the foundry.
And running parallel to that GPU scale-up is the highly anticipated launch of their next-generation server CPU, codenamed Venice, which is slated for Q2 or Q3.
And the projections surrounding Venice are aggressive. Analysts forecast it will drive 28% shipment growth and a massive 46% revenue increase within the server CPU segment.
46%. That's a huge jump for a CPU segment.
It is, but those projections are rooted in the underlying chiplet architecture Venice is expected to utilize. By advancing their packaging technology, they can drastically increase the core density per socket.
Without creating data bottlenecks at the memory controllers. Right.
Exactly. And for cloud providers operating those complex agentic AI workflows we talked about earlier, a higher core density means they can process significantly more sequential tasks on a single physical server node.
Which just fundamentally lowers the total cost of ownership for the entire data center.
Right. There is also persistent market chatter regarding a third major hyperscaler preparing a massive custom silicon agreement for 2026.
And the widespread assumption is that this involves Microsoft, which makes sense given Microsoft's massive capital expenditure budget for infrastructure.
A custom architectural deal like that would provide a highly predictable, multi-year revenue floor. It insulates the company from broader macroeconomic cycles.
And a custom silicon partnership of that magnitude would likely act as the definitive catalyst required to break through that $311 resistance level.
If we connect this to the bigger picture, the bullish consensus, which maintains an 8 out of 10 rating on the stock, treats this exclusively as a multi-year hold.
Right, requiring a 12 to 18-month horizon to fully realize the MI450 production cycle and the Venice CPU rollout. Entering a position at $245 carries acute short-term risk.
So the tactical approach involves identifying broader market pullbacks.
Yeah, and targeting the established support range between $225 and $230. You essentially have to let the underlying earnings growth catch up to the current valuation multiple before committing heavy capital.
Definitely. But overall, it remains an incredibly compelling operational turnaround.
Transitioning from budget consumer chips to the architectural foundation of the AI revolution. The May 5th earnings call will provide the first concrete evidence of whether their execution matches their ambition.
And as you evaluate the infrastructure landscape over the next year, deeply consider the trajectory of agentic AI.
It's going to change everything.
It really is. As large language models evolve from static query engines into dynamic multi-step orchestrators, the flow of data across the server rack changes completely.
And it leaves us with a huge question.
Right. Will the broader market eventually recognize that the server CPU, the central traffic controller handling the complex logic routing, is actually the most crucial, irreplaceable real estate in the entire data center?
Because if the orchestrator becomes the ultimate bottleneck, the company that dominates the server CPU market ultimately dictates the pace and profitability of global AI deployment.
Exactly. The balance of power between accelerators and traditional processors is clearly shifting.
It's an incredible space to watch. Well, thank you for tuning in, and we will see you next time on Smart Wealth with Joshua.